Oh, I'm so glad you could join us here on a Monday morning as we kick off a new trading week. Thanks for joining us today. I'm Marlon Bowling, your tour guide to the ag commodities. I want to welcome aboard the one and only Brian Hoops, the president of Midwest Market Solutions. He hails from Springfield, Missouri. And Brian, as I'm going through my notes here, I see where we had a little overnight sales activity. In this case, of course, it'd be over the weekend, but my goodness, we were a little bit busy over the weekend, I would say. Look at this. We had a sale of soft red wheat, 440,000 tons of it, to China over the weekend. That's a big amount of wheat. Now, corn, we sold 267,044 tons of corn to Mexico. And chalk went up for soybean meal. Look at that, 183,000 tons of meal for delivery to the Philippines. And it looks to me, Brian, like all these sales are for the current marketing year. So, yay, score. How about that? 3 sales over the weekend.
Yeah, it's good to have you back, Marlon, and your sense of humor here about these export sales.
So what do we do with this? I had heard in the rumor mill last week that it could be hard red wheat.
Yeah, we have been hearing this wheat rumor for at least a week, and it was hard red wheat, but now it turns out it's Chicago wheat. And you look at the overnight trade, and it looks like maybe someone knew that as they were buying Chicago, selling Kansas City. In fact, late in the week, last week, we saw kind of the opposite spread where traders are buying Kansas City, selling Chicago off of this rumor. And maybe somebody knew overnight that that wasn't going to be the case, that it was going to be Chicago as the announcement this morning. So maybe a lot of this is already kind of factored into the marketplace. The soybean meal sale, we haven't had one for quite some time. It's a hedge against Argentina production. We've seen meal futures really pull back here from their highs. In fact, taken out the lowest levels since early part of November, late October. They've given back pretty much all of the rally that we had in November because of good growing conditions in Argentina. Now, they were the Buenos Aires Grain Exchange was out on Friday afternoon and talking about their planning estimate for Brazil and Argentina. About 44% of the crop is in the ground for soybeans and 32% for corn. And so we're just at that point in Argentina where we can either start to add, subtract some weather premium. Market's been subtracting it in the case of meal and for soybeans. And, this is a hedge against prices at some point in time moving higher later in the growing season.
Okay, well, Brian was talking about the possibility that maybe the people involved in the trading of these export sales might have been doing a little business here in the markets before the announcement came in. That always happens, but let's take a look at what happened overnight. Let's go to the corn board here. Our quotes are from Bar Chart. On the corn overnight, well, we had the March contract. Remember, December's in delivery. March was down a penny and a quarter at 483.5. So it didn't seem to get any kick out of it there. In the soybean trade, well, we were lower there. January down 3.5 at 1321.5. That didn't seem to benefit from any export sales news. And the wheat, you had March Chicago wheat 4 1/4 higher at 607. So that could be a definite maybe there. On the hard red wheat in Kansas City last night, March was 3 lower at 643 3/4. Brian, do you think that's reflective of that maybe a miss on the rumor mill last week, that they were looking at the wrong class of wheat?
Yeah, that's what we think is happening. They had like I said, rally last week, and hard red wheat sold Chicago against it, unwound that spread overnight ahead of this export news. So, the news has been fairly favorable for exports. A very strong census crush report out on Friday, new all-time record reported for last month. The only thing that's kind of been a little negative here is deliveries against the corn have steadily increased. There were no deliveries Wednesday, then an increase in deliveries Thursday, and again on Friday to point where there's 650 contracts delivered for the corn. You can see that's putting a little pressure against the December contract, and it's really pushing those spreads even further than what we had imagined when you look out from December out to May or even to July.
Now, looking at the spring wheat trade last night and what happened there, you had Chicago going one way, Kansas City went the other. On the Minneapolis wheat, the March was down 7. Yikes, 723 1/4. That was within a penny of its low of the overnight trade there. It was about 12 cents off of its overnight high. It could be significant there. On the cotton market this morning, we have the March 58 points higher. Well, look at that, 80 cents even right now, Brian. So it has clawed its way back to that level. I do want to check in on the West Texas Intermediate crude oil market. And it's down 58 cents on the nearby January contract. We're quoted at 73.49 per barrel here this morning. As far as the U.S. dollar index goes, it's a little higher, Brian. December futures up 315 points, if I can spit it out. 103.515 this morning. And right now it's on the high of the day. That's on December, and the March is up 300 points as well. So keep an eye on those. And if you look at the Dow Jones Industrial Average futures, well, that one's down 180 points on December futures. We're at 36,123, still above 36,000. Gosh, the economy must be doing great, Brian. We'll take a break right here, and we'll come back and take a look at the rest of our ag commodity complex. This time, we'll be taking a look at livestock. Come on back. Well, we're back, and we're talking with Brian Hoops of Midwest Market Solutions. All right, Brian, I was gone Thursday and Friday last week, and I just wondered what happened in the cash cattle market. Can you get me updated there as far as what happened in the plains?
Well, nothing good that we really want to talk about. It was a $2 to $3 lower live market in the plains, about $4 lower on a dress basis, and the futures market pretty much collapsed once again. So we're trading below 170 in the D's and the February contracts and the live cattle, well below the cash markets. And so we've really lost this disconnect between the fundamentals and the cash versus where the futures are. And you see that in the live cattle contracts, you see that in the feeder cattle contracts. Feeder cattle index, the last report was up around 224, 225. And so, we're way below that on the futures. And that's why I say there's such a disconnect. Now, hopefully we can get back to trading some more of these fundamentals as far as the cash markets go, and the slaughter pace and cutout values, and the fact that the packer margins have improved to where they're now profitable by about $3 a head. But that's a big change from a week or 2 weeks ago where they were $90 to $100 in the red. So some positives are happening in the cattle market, but I think you're seeing such massive fund liquidation. We've went through from a net long of over 92,000 contracts to now maybe around in that 50,000 range, depending upon what happened Thursday and Friday. We've paired it in half, and there may be more to come because the technical nature of the futures have really fallen in here. And I'm afraid we may have some margin call type selling once again today, maybe a steady to lower opening. If we try and rally, I would suspect that rally gets sold by margin calls, people trying to get out of positions. Maybe we can stabilize at some point in here, but it does feel like we want to take a run at those lows that we posted 1 or 2 weeks ago.
But why? Why do we have such wide swings every day in the cattle trade? I mean, what is it about that? I mean, it can go $5 higher one day and $5 lower the next. Why don't they just move like $1 in between there and trade quieter? What's going on with that?
Yeah, we wish we could see more orderly type trade. Sometimes it's nice to have these big swings in the market. You have the big ranges. But the fact that there's so much volatility right now, that's what's driving this market. So we're not seeing the $1 and $2 trades. We're seeing big contracts being traded, huge volumes of contracts moving the market, buying and sell orders. That's pushing us $1 or $2 in the opening range, one way or the other, and then extending that by another $2 or $3 as people either get out or get into a position. And it's just creating a real volatile mess. And for the producer, it's extremely frustrating because you're out at the feed yards sale barns trying to buy some cattle and trying to get something hedged. It's really difficult and very frustrating.
Are we trading normal limits today? I assume we are.
We are trading back to the normal limits, and hopefully we don't test them or do anything crazy like that. I think it could be a little volatile, especially in the early morning hours. The cash is called a little bit softer again this week, so it's going to be a struggle for the futures market to really try and correct and push the market back higher. And deliveries do start tonight. We don't expect there'll be any deliveries whatsoever.
So February closed Friday 270 lower at 169.12. That's where we'll start today. January feeders were down 552 at 214.42. I'm glad I was gone Friday. Lean hog trade, we had February down 137 at 70.10. Okay. Well, thank you, Brian, for summarizing everything. I appreciate that a lot. Brian Hoops of Midwest Market Solutions with us here on a Monday morning. Good morning, Suzanne.